Since gaining independence in 1960, Nigeria has explored 5 years developmental plan, one of the structural adjustment program, 2 3-year rolling plans, 4 visions and strategies, including recently launched National Development Plan. But there seems to be an endless search for the best strategy for our developmental purposes, as the country is still wandering around and manipulating all sorts of developmental initiatives to salvage the country's stunted economic growth. It is utterly disappointing that all various planning initiatives the country had adopted had not delivered the much expected results. Rather, the country is still battling with mounting developmental challenges across major sectors of the economy. Given that National Developmental Plan designed to succeed the economy recovery and growth plan has largely performed below target in the attainment of its set objective, the country's economy is expected to experience positive development across all sectors in the coming years if the set goals in the recently launched NDP are strategically executed. It will interest you to know that 348.7 trillion naira National Development Plan for 2021-2025 period is built around the 6 concepts of economic growth and development: infrastructure, public administration, human capital development, social development, as well as regional development. Well, to give more insights into this, I have joining me via Zoom to talk about this a macroeconomic and public policy analyst. You know him, Professor Ken Ife. Good afternoon, Prof. It's really good to see you, and compliments of the season.
Oh, hi, good afternoon, and thank you for having me.
Yes, Prof, I want to start with the global recovery that we have seen in 2021. That's before Omicron came on board. Now that has happened, many are saying that caution has to be taken because we don't know what will happen. There'll be restrictions in some countries. Some countries are still thinking of even more tighter restrictions. Now, what do you think? Let's do an overview of 2021 first and all that we have seen before we move into projecting to 2022.
Well, the Omicron has come to stay and is obviously transmitting at a much faster rate than ever before. But the thing is that the global economy is fully recovering and in many respects even exceeded the pre-COVID figures. You can see trade in Nigeria has gone far beyond the pre-COVID levels, albeit to our disadvantage, because we are still locking 3 trillion in trade deficit. Now, the thing is that the population are far more prepared for this Omicron than we were in March 2020, when we first got the wind of COVID-19. So what that means in effect is that it is really a measure about intensifying the preparedness rather than lack of it. It's about taking the third dose, booster dose, rather than taking one in the first one. So it's a different ball game right now. And we don't see that it is going to disrupt the supply chain the way we had it last year. In fact, when countries like Canada and UK and Saudi Arabia jumped the gun and began to restrict flights from Nigeria, and Nigeria fought back, they were forced to reopen the airlines, the true route. So it means that they are saying to them, look, wait a minute, we are better prepared than you thought. So look, we're doing all that we can. After all, it was from South Africa that we announced the presence of Omicron when it was already seated in all the other countries. So the fact of the matter is that they are no longer thinking more about supply chain disruption than about the intensity of the inoculation and all of that, and all the PPEs and all of that, just ensuring that people apply more those precautionary measures, but you can't stop them. So the answer to your question is that the impact is not going to be anything like what we saw in 2020.
What about the impact on commodity prices now, and most importantly, crude oil, which many are saying that the demand could actually drop? Already OPEC and OPEC Plus were planning to add, already they've started adding to production monthly. Do you think that will be sustained if these restrictions are anything to go by?
In fact, even our plan, our budget, our national development plan, all of them are predicating on a stable rise in the price of crude, following, of course, from American Energy Information Agency's projections. And these projections are that price of crude will remain high from 70 to 80 and more, over the next 3 years. And there's several reasons for this. One is the COVID recovery of the supply chain and the production facilities around the world. Number two is less investment going into exploitation and exploration for oil, because that is what increases supply of crude. So when many investors are now less appetite to invest in exploiting new sources of oil and finding new wells, because they are expecting by 2030 that there will be less demand for crude, because of electric cars and all kinds of things. So that sends a signal that the prices are going to be high, because every day there is the cost of the drilling the crude keeps increasing, because it's more expensive to get the last drop of crude in your well as it is when you discover new wells. So that those two factors inexorably are pushing the prices. And then you've seen less aggression from America, from the shale oil side of the thing, where the federal government is saying to them, I don't want shale oil in federal lands. So it's all working to our favor. So in all, we are more optimistic that the prices will be reasonably high, above benchmark, over the period of the next 3 years.
Prof, for 8 consecutive months, we've seen inflation decline from about 18.2%, and at the moment we're around 15.4% for November 2021. Now, this trend is something that many will say is a welcome development, though some will argue that it doesn't actually correlate with the prices of goods and services. That's talking about the hike in the prices of all that we need, even at this time, festive season. It's a two-way question. Do you think we'll continue this trend, that's this decline, considering the fact, this is what we've been talking about, everyone has been talking about, the fact that subsidy might be removed in February, both on electricity and on PMS. If that happens, what do you think would happen to inflation?
Well, first of all, the projections to 2025 on inflation is that it will come down to 10%. Some projections actually say 9%, single digit. So then the drivers of inflation are also attenuating, because the key driver is, one, money supply, then two is the food sub-index. If you look at the food sub-index, it has always maintained a distance of 5% to the core inflation. Not to the headline inflation, this composite price in the CPI, over 3 years. But now that 5% has shrunk to less than 2% now. And at the same time, it used to be about 9% gap between food supply sub-index and core inflation, because core inflation is all indices minus food supply. So it used to be around 9% gap. Now it has narrowed down to under 3%. So what that says is that the food is driving the downward trend on inflation. And you can see that compared to last year, where we had flood. This year we didn't have flood. And that flood have affected grains so much. You remember this time last year, we were buying onions 4,000 naira per basket, and the tomato 3,500 naira per basket. I was in the market yesterday and this morning, and the same onions are now 1,500, and the tomato 1,300, 1,004 basket. So there are areas in the food, especially the grains, where the prices are coming down. But the fact that they are coming down on food does not mean that all the spare parts are not going up. All the other imported related items are going up. So other things are going up. Transport costs are going up. But on average, the whole thing is coming down and driven by the food. The food is the main driver of very high inflation figures that we are seeing. But don't forget, that there are two aspects of this figure. There is the standard inflation is based on a 12 months. So is what you saw today compared to the corresponding period last 12 months ago. But, so whilst in relation to last year, the prices are coming down, but month on month is going up. You see, if you look at the headline inflation, is where 15.4 is down compared to 15.99 last by October. But core inflation is actually gone up from 13.23 to 13.85. And if you look at food is down, and is the driver, that is the driver. Then urban inflation is gone up month on month from urban sub from 15.47 to 15.92. Now, when urban sub is higher than CPI, being at 15.992 is higher than 15.4. What it tells you is that the theater of inflation is in the urban areas. And then compared to rural is 14.8, which is lower than the CPI. It tells you that if you know the distance between rural and urban is always the transportation cost, the energy cost, all the whole things are happening in the city. So spare parts and all that, they all consume more in the city, clothing. So all those things breeding high inflation are always in the city, compared to the rural areas.
Well said, Prof. Prof, let's continue with also our reserves, because it's an opportunity for us to take this, at least talk about those that we can really talk about, the key issues surrounding the economy for the year 2021 as we wrap up. But I see that the reserves are doing pretty well. Many will say maybe because of the Euro bonds and all of that, but it's closing the year very, very good. We started the year around about 35.6 billion US dollars, but it's up to about 40.79 as at December 17, 2021. This looks good. Do you also see us sustaining this? We still have issues around FX, which remains very, very worrisome.
Absolutely worrisome. Now, the thing is, normally, under normal circumstances, we would be expecting $3 billion every month from NNPC heading to our reserves. But there's nothing like that this whole of this year. Central Bank hasn't got anything because the NNPC did a direct swap deal with the refiners, foreign refiners, sending them the crude in exchange for refined products. And then the balance of the money they have, they use to subsidize. And they send the governors away empty-handed. So CBN has not been benefiting from those. So the only source it's getting is all other sources, including, of course, the external borrowing. The thing is that with the forex that we have has to prioritize debt service because we have debts that are incurred in dollars and denominated in dollars, and we have to service them. If we ever miss one payment, then the rating agencies will come down on us like a ton of bricks. And everything will go, will go haywire. So there are other priorities. So I really don't know how the central bank is able to muster this marginal increase in the forex, in the foreign reserves, and still able to temper the. By and large, 93% of our forex activity are within the formal banking sector. It's only that 7% that is in the BDC that is causing all the furore in the country. That's what is causing all this palaver. Because there's dollarization of our economy, there's increasing security, people are speculating more, there's higher speculation in the speculation affects forex the most. And then you have traders that are all jumped into buying dollars at any cost and importing from China. If you look at the trade figure last month, it was ridiculous. That only country that we are at par with is Netherlands. Not Netherlands, it's India. 700 plus billion import, 700 plus billion export. That's the only country that on paper you should be doing business with. Netherlands is only halfway. But to see China drawing 2.44 trillion naira from Nigeria of imports and nothing to show for the export is ridiculous. So I think we need to go back to the drawing board in terms of that. I'm glad that more this thing is kicking back. the yuan currency swap is kicking back, but it's scandalous for us to be doing this sort of business, and it's because people are rushing to China, because anything you bring from China, you must make profit and pass through the inflation, and there's no restriction on imports. Borders have all be opened, so it is the customer that is suffering.
Really suffering. Prof, let's now do a little bit of also assessing efforts by the Apex Bank. Yes, many have said that the CBN has been almost everywhere trying to just reactivate, recharge this economy, if that word can be used. But let's look at some of the efforts by the Apex Bank to stabilize the economy. We've seen direct focus on the pharmaceutical space. We've seen direct focus on the textile and apparel, talking about clothes making and all of that, cotton and all of that. And the big one is agric, which we all know, the Anchor Borrower scheme and all of that. Prof, let's do an overview of all of this. Many would say that when the Lord is given, much is expected. So are you thinking, or do you think that we are getting enough from all of these investments?
Well, I addressed the bankers committee. Was it last week? I think it was last week. And just all the things you said here, I put on the table. This current central bank is the most MSME friendly of central banks in our living memory, because it believes in rebuilding the economy. It believes in fighting less of the political economy battle and just create new pathways so that we can have prosperity, because of the sort of the challenges we are facing. This country faces three existential challenges. We have the insecurity, which do nothing is not an option. We will all be overrun like Afghanistan within weeks. And I don't know how many people have somewhere to go. Then you have the second one, which was the COVID. And look at the way CBN led the attack on COVID last year. Quite unlike the previous recession, stagflation of 2017 CBN was left to fight it alone, and that was why he tried all the macroprudential measures. He tried devaluation, all that. He went to capital account control. It didn't work. He now went to policy demand management, and then expelled 43 items from a forex eligibility. But he didn't stop there. He decided that it's not enough to say to them, go away and go and find your currency. You have to do something about export substitution, import substitution, and backward integration. So he decided to start funding that gap, which is to put money on rice and 10 presidential value chains. And you've mentioned some of those. 4 million farmers in Nigeria suddenly accessing finance with no collateral, just their BVN, and then the satellite coordinate of your 1 hectare or whatever. But it's not just that money has diffused and it's about over 800 billion naira. Now, it's not just that, but what it has done was to fundamentally restructure that industry and make sure we now have commercial farming, and then you have those farmers, subsistence farmers, and outgrowers. So we have now built and cultivated the base to provide agro raw materials for our industries. So that's why instead of taking on the industry, which is 80% of which are just importing raw materials from abroad, and pharmaceutical just 100%, he said, no, leave that political battle. I will set up a new vista. And that's why he said 100 for 100 PPP. In 100 days, 100 companies will get as much as 5 billion each. About 360 of them will get in a year. 1.7 trillion is going to be on the table per year. That is to create new caliber, where at least 50% of your raw material must be from Nigeria. At least 80% of your workers must be from Nigeria. So they are not fighting the old regime. Leave them there and just create a new one. You already created raw materials. You now link them. And then you close up the biggest weakness in our production system, which is the manufacturing segment. That's the biggest weakness. The link between the production and processing is the biggest link, weakest link in the economy. So now he's addressing it. And I'm asking all the banks to rise to this challenge and support the central bank so that we can create new opportunities. Now, the third existential problem is unemployment. Now, to tell the government that you will do nothing is not an option. It's not an option because if you have 33% average unemployment and young people is over 52% and then underemployment 20%, you are telling me to do nothing when 72% of your young people are roaming on the street without jobs, when 7% of the people graduating are the only ones that get jobs, 93% no job. You can't do that. You just cannot sit down. Whatever it takes to engage them and to borrow money to make sure that after all, borrowing, you can only use it for capital investment or for human resource development. And the human resource development is health, is education, is employment. So we have to go down that route. Because if you remember in Tunisia was 15% unemployment. One young man came out on the street, put petrol on himself, and the rest was history. The whole of North Africa countries were in flames. And we are about 5 times more than that number. So nobody can say that, oh no, we've been talking about all this debt. You have to grow infrastructure, for goodness sake. Well, our stock of infrastructure is only 35%. South Africa is 80%. Most countries are 100% of GDP. And one is only 35% of GDP. I believe that we should spend on infrastructure that connects to economic activities that have a good chance of yielding positive return. So that's why the law requires you, the Fiscal Responsibility Act 2007 requires you to do a cost-benefit analysis and borrow money on concessionary terms for a long period of time and on those conditions, those 2 conditions. So that's the law. And we can't be sacrificed because of numbers and policies. We've got to have to look after ourselves and look at the coordinated measure between the fiscal and monetary authorities last year, very, very quantitative. We see them rolling out 3.5 trillion, the fiscal authority 2.3 trillion, and the even CBN put 1.5 trillion to the fiscal sustainability plan. And all of them just brought us out straight away within a quarter out of recession. So we have a price we are paying, which is inflation, higher inflation. Yes, we are paying that price, but it's a price worth paying as long as you are addressing growth and employment and the poverty reduction.
Finally, now, Prof, you've touched on that critical thing to infrastructure, and it takes me to Infraco, which the CBN also has a role. I think the CBN, NSIA, and the AFC will be coming together with about a seed capital of 1 trillion naira. That's about $2.6 billion. That's huge. Now, what do you think, or what's your assessment with regards to that initiative, Infraco? We've had other initiatives there to help straighten infrastructure, like the Presidential Infrastructure Development Fund. All of this is just to help shore up our infrastructure level. What do you think of Infraco, and what positives do you think will come out of it if properly implemented?
Infraco is a game changer. The federal government put 1 trillion capitalization, and then they are heading to the market to raise 15 trillion. So what is it going to do? We expect it to be world-class management so that it can bring investors knocking at their door. We expect it to take over some 20 to 26 major infrastructure projects the federal government is handling. And then, it may have to rework some of those just to make sure that it all stacks up. And then rock and roll. We have to it will get more private sector engagement into this infrastructure business, especially the PPP, and knowing that there are thousands of federal government projects that need to be privatized. They are now going to be in safe hands. Now, we also know that there are also things that are foreseen by the National Development Plan, like some trusts, new trusts, and some other additional funding frameworks that are anticipated that will come up to ensure that and even bonds, much more deepening of the bond market to ensure that a lot more variety and the blended finance, of course, they will all come into play to ensure that we can raise that order of revenue, capital we are looking for. 350 trillion, about 348 trillion, it's not a joke, because of that 348 trillion, federal government and state governments and local governments are going to be dealing with looking for 50, and then the private sector will look for almost 300 trillion. So you need the likes of Infraco to be in place to drive that engagement of private sector and revenue generation. They're bringing in more foreign investors and sweetening up the infrastructure plan to enable them have more confidence in investing in our economy. So that is where I find I'm so comfortable and feel very relaxed that we're going to have a better story to tell by 2025.
Let's wrap up on this note, Prof. I took out some of these very key issues: crude oil production, limited investment inflows, high demand for forex, and exchange rates. It seems to be a little bit stable in the I&E window with all of these efforts now being made by the CBN. But with all of these issues, what are we looking at in 2022? Now let's now project in line with government's developmental plans. What do you think this will affect any or make way for us to move forward?
The major projections that I have looked at,
yes,
and I used those to talk to the Bankers Committee last week. I looked at major macroeconomic projections from different sources, from World Bank, from IMF, from CBN, from National Bureau of Statistics, from UNCTAD. The worst case scenario is a leveling over the next 4 or 5 years. But the base scenarios are all going up, really going up. The base projection is 5% growth, GDP growth rate. That is the base projection. But we know that sectors vary in their growth profile. If you look at the financial sector and banking sector, they will grow more. In fact, within the projection, they're expected to double in size by next, from anything between 150 to 200%. So by 2025. So I have to raise those, and even the transactions are even going to increase about to 500, from 114 trillion to about 500 trillion. So I was telling the banks to begin to think about the nature of the infrastructure that they will require to put in place to be able to handle this order of revenue. And suddenly it's not going to be opening new banks. It's not going to be opening new ATMs or employing more staff. It would have to be how much technology you are going to engage to be able to handle that order of revenue and support the growth. And I don't think everybody found that funny, but that's the reality of the matter. But then, so what I'm saying in effect is that some sectors that are driven by technology would grow higher than 5%, while obviously there are other sectors like agriculture that are going to struggle to even meet the 3% population growth rate and let alone exceed it. So, but on average, it's expected that we will come up. But if you look at the current growth rate now, we're over 3% up to today. So by the end of this month, we will see where our finishing line. And I suspect that because we've hit 5%, hit 4%, even if we get 3%, then we will level off above 3% for the year, which is encouraging. Now, better oil revenues next year will drive the charge, because our growth is coming now more from non-oil, which is a good thing. In the next budget, we're expecting the oil composition of government revenue to drop to 43%. Now, this is significant, because from 60 to 55 to 50, heading down to 43% means that if we do have exogenous forces at work in oil and gas, they may not drive us into inflation. Our economy is getting more resilient. In the same way, I also saw the projections of next year. The debt service to government revenue is going down. It's going down because more revenue are coming. There's more aggression led by Ministry of Finance and Senate, hounding everybody, every agency into submission to come and pay in their money into the Consultative Revenue Fund. So there is a lot of drive, and you've seen the PIA, the Petroleum Industry Act, emboldening the FIRS to say that they are expecting almost double their revenue next year, over 10 trillion. So all of these are going to push the paltry 7% government revenue to GDP to somewhere around 15%. That's the projection of government. But I know that all the other development partners have been projecting somewhere around 8.8%. They are not seeing that 15 as plausible, but I see it as possible. So that's why the picture is going to look much, much better next year.
Now, finally, Prof, finally, many will say the monetary side and the fiscal side must work hand in hand to achieve And that's all-inclusive growth that we talk about. Let's look at our budget. Many will say it's timely, coupled with the fact that it comes along with the Finance Act. Now, what do you think this holds for us moving on?
Do you mean the Finance Act?
And yes, coming along with the budget every year.
No, the budget is very hopeful. You know, it sends out a good message. The Finance Act, well, one good thing about the Finance Act is that it's part of the gains brought in by the current administration. That every year is now, you just have to bring an act to fine-tune all the rough edges and then make sure that we are constantly reforming and modernizing. So that's good on that count. And then, of course, the early implementation, but from January to December, you know, is excellent. We've had an administration where for 4 years, they never delivered more than 6 months in any budget. So this time is more workable. That means a lot more money can be spent on capital expenditure, because that's always the last in the ladder. Right. Having said that, the Finance Act, there's something interesting I found in the Finance Act, which is trying to deal with foreign elements that make money from Nigeria without paying taxes. Let me explain. In services, there are 3 modes. There are mode 1, mode 2, mode 3. You see, the law says if you are, wherever you are, if you are making money in Nigeria and generating profit in Nigeria, you have to pay tax in the constituency where you generate profit. But so when you look at one of the modes, which is somebody is outside for another country delivering services, of course, it's got to be electronic and all that, and then they're making money. So there's another one where you could come into the country, do business, make money, and bugger off. That's the second one. You are not actually resident. Then the third one where you come in, you are resident, and you are making the money. So in all 3 cases, they are now addressing those to ensure that they can collect money. You know, I mean, you could have the case. Remember the case of DSTV. We've been having for many years now, and they're trying to sort that out. So these are some of the things that act is actually bringing to the fore. But they may well be other ones that I'm not comfortable with, where they're trying to relax the Fiscal Responsibility Act 2007, which says that the only reason you can borrow, first of all, remember that borrowing and debt management are all in the exclusive list. So governors can't play in that area. So, but when you start thinking about diluting the main criteria, then we have to get more clarity on that, because at the moment the criteria is borrow for external, borrow both domestic and foreign must be for capital expenditure. You don't borrow to pay salaries. Then secondly, it has to be for human resource development. And then this human resource development involves training, education, capacity building, and then of course health is human resource development, and then employment is human resource development. So those are the areas that it allows you to. It doesn't allow you to stray into recurrent expenditure areas, and so we must be careful that and then it says that there must be a cost-benefit analysis for whatever it is you want to borrow. And it has to be for a long term, and it has to be on a concessionary term. And concessionary terms are regarded as around 3%. So we have to watch that we're actually complying with that act and not hastily amend them to suit some exigence and then throw the door wide open. So anything that is by way of amendments has to be clear, very, very clearly spelled out, so that we don't run back to 2005 situation we were in 2005.
Well, it's a good way to leave it. I've been speaking to Professor Ken Ife, who is a macroeconomist and a public policy analyst. Prof, thank you so much for taking us through all of this very important developments across the year 2021. We really appreciate this. We'll keep a tab as we move into the new year. Merry Christmas and a Happy New Year, Prof.
Thank you. Thank you very much. I wish you the same.